even if asset prices do go up, the reason why they might go down, if we increase interest rates, asset prices go down because there isn't as much demand for them as there was before. You know why? Because people are now putting all their money in bonds that give them an even better rate of return and an even safer rate.
It's basic income for people who already have money.
How is that a way to deal with excessive wealth?
This whole thing never gets to, okay, you're the government. You can buy whatever you want that's priced in your currency that you issue. Is there a better way to solve a housing shortage than tinkering with interest rates? This is the MMT Podcast with Patricia Pino and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. If this is your first time hearing about MMT, you might want to listen to our first 3 episodes for an introduction, which I've linked to in the show notes, along with some other things that relate to this particular episode. And as ever, I've linked to where you can support this podcast financially via patreon.com/MMT Podcast. Support starts at $1 a month or £1 a month or whatever the equivalent is wherever you live. And no matter what level of support you give, you get early access to all of our episodes and patron-only episodes where you can ask me and Patricia MMT questions. We're 100% listener funded. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. A big thank you to all of our supporters so far, and thanks as ever for the time you put into understanding MMT. Let's dive in. Welcome one and all to the MMT Podcast. I'm Christian Riley.
And I'm Patricia Pino.
And this is a special episode that we're doing. What we do monthly is an episode for patrons where they send us questions, and then we either hope to answer them fully, or if we can't answer them fully, we say, oh, you should read this article or that article or watch this video for a little bit more clarity. And we got so many questions, and they're all so good that we thought we would do one of these episodes for the main show. So we're going to plow into the questions, but I can't resist it, P. We have to talk about the news of the day. I'll just throw the headlines over to you, and you can just tell me what makes you angry about these headlines. The headline is in The Independent: Rishi Sunak will be short of money despite historic tax rises, IFS warns. And that's in The Independent. That is the Institute for Fiscal Studies saying that Rishi Sunak will be short of money. The Chancellor, the man holding the purse strings of the government of Great Britain, will be short of money. Now, let's just say there's somebody out there that's just never read an economics textbook. Why is this kind of coverage completely misleading?
There are various reasons why this is completely misleading. First of all, the government, as we know, cannot run out of money. It's a currency issuer. It cannot run out of money. There is no way that the Chancellor of the Exchequer of the United Kingdom could ever be short of money. He can have other problems. He can have inflationary problems, or he can have resource constraint problems, but there is no way that he can run out of money.
Go back to basics.
Right, okay.
Why is that? Why can Sunak not run out of money? Or why can the government of the United Kingdom not run out of money?
Because every time that Parliament approves spending in the United Kingdom, money is created and literally spent into existence. That happens every time it spends. It doesn't matter whether taxes are collected later or bonds are issued. Money is always created. So there is no prerequisite to collect taxes or to have money available in an account somewhere in order for the government to be able to spend that money. That would be the way that you and I are constrained as currency users, or households are constrained. We have to raise revenue before we can spend that revenue, or we have to borrow from commercial banks or somewhere else. We have to find the money before we can spend it. The government, as the currency issuer, does not have to do that.
How would you go about addressing somebody that would say, look, I don't believe that. I don't believe there is an entity in the economy, an organization in the economy that issues money. Money always has to come from somewhere. How would you address that?
Well, if somebody doesn't want to believe something enough, they'll always find a way not to believe it. But I would hope that anybody who's curious about how the government actually functions would have a look at how the accounts function. And our friends that we've had here have created a really good report on how the UK government spends and what all the accounts do.
I'll just interject. We'll link to that episode. It's a 2-part interview. But more importantly, it's a report that they put out, and that's on the Gower Initiative for Modern Money Studies website. And it's called An Accounting Model of the UK Exchequer. And that was written by Richard Tye and Neil Wilson and Andrew Barclay. And they're wonderful, friendly people. And they've answered readers' and listeners' questions directly as well. So they went in there and used freedom of information requests and everything that was publicly available and pulled together, how the payments clear in the payment system of the UK. So we've, our banking system, which, if we want to receive money from people who aren't us, we have to have a bank account, or even if we get paid in cash, we want to pay it into the bank. But not a lot of what the money we use is cash. Most of it is ledger entries on electronic spreadsheets at a commercial bank in Great Britain. And so these are all spreadsheet entries. And then the master spreadsheet where the banks bank, they bank at the Bank of England and they have accounts there. And again, it's just spreadsheet entries. So when the government spends, it creates what are called bank reserves, or sometimes called settlement balances at the Bank of England. And that money is described by Randall Wray, L. Randall Wray, one of the primary academics in modern money theory, as high-powered money. It's at the top of the nation's currency hierarchy. So the government can create those pounds, and those balances are what is used to clear payments from the government to the private sector, and also to clear payments between private sector individuals via the banking system. So, for a back to basics primer on this, you can listen to our first 3 episodes. And when you're ready to get really into the weeds, you could listen to our episode 13 with Dr. Stephen Hale. And when you really want to see the guts of the system, the plumbing of the system, the paper that we just mentioned, An Accounting Model of the UK Exchequer, is there, which I'll link to in the show notes. And also, we have, central bankers say it all the time. Ben Bernanke, the Fed chair, during the great financial crisis, was asked on 60 Minutes, sort of a primetime current affairs show in the States. He was asked by the anchor, Scott Pelley, I think his name is. He said, look, where is this money coming from that you're using to do quantitative easing or bank bailouts? Is that taxpayers' money? He asked him point blank, is that taxpayers' money? And the chairman of the Federal Reserve says, no, we have bank accounts at the Fed where your banks, and we just use the computer to mark up the numbers on the spreadsheet, and that's it done. I'm paraphrasing there, but that's a very close paraphrase. So there's lots of evidence there. So anyway.
Well, the key takeaways from the paper actually were that once Parliament approves the spending, there is nothing that can stop it from happening. Yeah. The Bank of England has to honor that spending and has to provide the funds to spend into the economy. That has to happen. And the other thing is that there is nobody's checking whether there is enough funds in some account somewhere in order to make spending available. As I said, as soon as Parliament approves it, then those funds are available. That's what happens. So taxation and bond issuance are things that happen after the spending. And the bond issuance in particularly, that is done as a reserve drain operation. And that means basically as the government spending and creates money, it creates base money, which we call reserves. And then that then can be drained away through the use of bonds. And they do that in order to meet their monetary policy target, so their interest rate target. And they use bonds to do that. But it has nothing to do with funding the government.
Yeah.
So with Rishi Sunak's comment, I think what upsets me the most, and you tell me if you agree with me, is that when you tell people, and when you tell particularly mainstream economists, that the government cannot run out of money, at some point they go, "Yeah, of course, we know that. That's like obviously we're not stupid. We know this. You're not saying anything new, MMT. What are you talking about?" And they shut us up for a moment there. And then they come up with things like, "Oh, the chancellor is going to be short of money."
Yeah.
Why then are they speaking as if money is a finite resource? I don't understand.
Yeah, well, it just points out how ideological and political they are. They're not neutral commentators, just calling balls and strikes, as it were. Yeah, they're bringing a worldview to the table, and it's absolutely completely inapplicable. As Warren Mosler, the co-founder of MMT, always says about the US government, he says, look, the US government neither has nor doesn't have any dollars. It's the scorekeeper for the dollar. It moves numbers up and down in spreadsheets, like we started to say earlier. So it's a little bit like, you're at a sports game and, one of the teams keeps scoring goals and nobody worries about the scorekeeper not being able to type the score into the scoreboard. Yeah, and so he says that about the US, and that is true for the UK as well. The UK government is the scorekeeper for the pound, so it's inapplicable to talk about running out of money.
Imagine if we were in the World Cup, in the football World Cup, Christian, and suddenly the game had to stop because one of the teams had scored a goal, but the goal could not be assigned until they collected a goal from somewhere else.
Yeah, exactly.
And everybody just hang around waiting until a goal can be collected. It's just nonsense.
So going back to the Rishi Sunak thing, Sunak is, according to The Guardian, planning $2 billion in cuts and the UK's highest peacetime tax rate. So what's happening is every year the government spends some money into existence, like we just said, and it taxes some back, and it needs to impose taxes on the population because the government taxes us to get us to need its money. So it imposes a tax in a thing that only it is allowed to create, the British pound. And that's the way the model works. Now, before the government has spent any money, let's just imagine that theoretically, we're now in debt to the government in pounds, not in gold or Bitcoin or seashells. So we now need to go out and earn pounds. And that's why the government imposed taxes. This is a framework called chartalism. And so now we need to go out and work for pounds. And that means the government can then spend its otherwise worthless pieces of paper or spreadsheet entries into existence to pay people to do things and buy things, materials and labor. And so every year the government spends some money into existence and it taxes some money out of existence. That's what happens when you hand it back to the government. It's called revenue, means return. You return it back to the government. And the difference between what they've spent into existence and what they've taxed out of existence, we call the government's deficit because it's taking in less than it's spending out. So we say the government's running a deficit, but that deficit resides in the private sector until it's taxed out of existence. So we're the private sector. So the idea of cutting the deficit, lowering the deficit means that, wherever there's a deficit, there has to be a corresponding surplus. So the government sector's deficit is the non-government sector's surplus. So that means that our money literally shrinks when they plan to shrink the deficit. So the non-government sector as a whole, it shrinks. So at a time of economic stress and strife that we've just been through, I mean, we've been going through it since the 80s, but, it really came to a head in the COVID crisis. As a response to what's happened in the economy recently, planning to cut government spending and hike up taxes. I mean, Patricia, help me out here. But why is that that's just running in the wrong direction? Am I right?
Well, remember when we were chatting with Warren here in one of the latest episodes, and there was a question to him No, actually, I think it was on the MMT European conference that when we were, but we have the recording in a previous episode. And somebody asked him what would happen if the government suddenly took away the support that it had given during the COVID pandemic. Would we have kind of a collapse in the economy? Would we see a shock, in the economy? And Warren said that, yes, we probably would. And that it happens a lot more often than we realize that it happens. And I think that's the direction that the government is going in. The economy is just recovering from the pandemic. Yes, there's a lot of savings from people who have not been going out and from the lockdown, and people who are keen to spend it because they've spent 2 years locked up. But overall, there is a lot of poverty being caused by the pandemic. People who haven't been able to work, haven't had the income they need. A lot of people dependent on universal credit, which they're now cutting. They're taking all that away, like pulling the rug from underneath all of us. And they're increasing national insurance. They're taking the opportunity to introduce quite a lot of regressive taxation.
I'll just explain what you mean by regressive taxation as well, P.
Well, they're focusing on national insurance and on things that they can collect from at entry level, taxpayers. If they really cared about balancing the budget, I would actually be a lot more relaxed about it if they wanted to increase taxes on luxury items and rich people, and because that wouldn't have such a big impact on the economy. It would appease them in some way, I guess.
Yeah, just to jump in with the MMT view again. If you're new or newish here, when you increase taxes on the private sector, you take away some of their spending power.
Yeah.
I've heard Warren phrase it like this before, where us, the private sector and the government, are shopping in one big shopping mall, one big Walmart. And, if we can both spend to infinity, obviously prices will go to infinity. So the government needs to do something to rein in the spending power of the private sector, and taxation functions to do that. When you raise taxes, you take away the spending power of the private sector, and you might want to do that if the economy is at full capacity, if everybody's got a job, if there's nothing that you can create an infinite number of pounds as the government, but there's not an infinite quantity of stuff for sale. So to cool down what they call aggregate demand, it might be an idea to raise taxes, but we're not there. So what Patricia's saying is if you're just bothered about making the numbers add up so they spend as much as they tax, you could take it from people with lots of money
who don't spend it.
That's why,
or who spend it on frivolous things like
cock-shaped rockets to nowhere. But that would make the numbers add up, but it wouldn't actually have that effect of cooling down inflation because they weren't going to spend the money anyway. That's why they're rich.
So it wouldn't crash the economy.
It would be nice to make those people less rich if you have a certain political bent, which Patricia and I share. So, that would be another reason to raise taxes. So yeah, sorry to keep breaking in with these sort of basics.
No, I'm sorry. I'm going into a bit of a rant, actually.
No, it's me. It's me. I want you to rant, but I just thought I would interject with some basics.
I realize I'm a bit all over the place. It's just there's so much that can be criticized here. So the Tories have this sort of leveling up agenda, and they've sort of sold themselves as or they're trying to be perceived as the northern powerhouse. We're going to try this lefty thing of investment, and they're trying to give themselves that look. But Rishi Sunak is actually far more fiscally conservative than the others, I think.
It was within the last year he was talking about conservatives have, and this is his words, a sacred obligation to balance the books.
Right, yeah.
Again, and if you think about what we just said earlier about balance is not what you want. One side of the government sector, private sector ledger needs to be in deficit so that the other side can have surplus, so it's normal and rational for the government to run deficits so that the private sector can have net financial assets, like net financial wealth, that the private sector can save, not money that they've borrowed into existence, but actual solid financial assets. I can't think of another way to say that.
Yeah. So the Tories have introduced this policy as well to address the social care crisis, because if you're from abroad in the UK, a lot of people spend a lot of money in end-of-life care and in social care. So it's very expensive and the service isn't very good. So there's been call to address this problem. And Corbyn had a kind of a national care service as part of his program, publicly funded and publicly run social care services for everybody for free, right? This is the way the Tories have dealt with it. They've said, okay, well, what we're going to do is nobody has to pay anything more than £84,000 from their kind of state, because they sort of expect the elderly to have homes, some sort of asset at the end of their lives that they can sell off and then fund their social care that way. Even though maybe for my generation, that may not be something that we can count on.
Exactly. And the next generation coming up, I mean, they leave school with tens of thousands of pounds of debt, and
it's just getting worse and worse. But the way they're doing this is they're saying, okay, nobody's going to have to pay any more than 84 grand from their state. So it doesn't matter how much money you have. If you hit that 84 grand, then the government has to pay everything above that to the private social care home. So it's sort of like a subsidy into the private sector. But, and this is a very important caveat, the entity responsible for making up these funds isn't the central government, who, as we said, is the currency issuer and has funds available. But they've given that role to the local governments, the ones who do not issue currency, who are constrained by the taxes that they take in, and therefore who in poor areas will have less taxation and have less means to deal with this policy. So what they're doing effectively by loading local governments with this is very sneaky, but it's like a way of proclaiming your support for a social policy, for public purpose. Social care is a way of addressing it, if not a very good one. But at the same time, using that to basically undermine every other public service offered at local level by your local authority, because you're burdening them with this additional expense. So there's a lot to be just outraged at this, and just the sheer sneakiness of it.
Yeah. But obviously, if you don't understand the way the government spends, and that the central government is the currency issuer, and the rest of us, including municipalities and local governments and councils, are currency users who can run out of money, who need to borrow or find other ways to attract revenue, to attract investment. If you don't understand it that way, you think, oh, good, the public sector is providing something.
Yeah.
And, this is the whole point of why we do this podcast, because this is a problem. It will become unsustainable. Like you say, Patricia, those areas.
It will come at the expense of something else.
Exactly.
Something will have to give.
But you can really see that, ultimately what's going to happen is, because they take money from the council taxpayers, and they need to take it in to spend it out again, because we said they're currency users just like the rest of us. Eventually, they'll be able to say, well, this is your money that we're spending. Don't you want better value for money? Well, what gives great value for money? The private sector. So let's kick all this provisioning over to the private sector. And obviously, if you've been living in the UK, you've seen what the private sector has done to the rail system. It's basically, it just adds another layer where you've got, on top of everything else you've got to pay for, you have to pay huge salaries and shareholder dividends. And it's just completely not the way to go. It's not even efficient. And also this idea about, it's not even a conservative idea, is it? Because it takes away the incentive to build up wealth, doesn't it? This idea that you have to save everything for retirement. So, say you do have a house or something, but basically they're saying, yeah, you've got a house, but you're not allowed to keep it. At the end of your life, you've got to eat your house. Mm-hmm. And then once that's all gone, then we'll start ponying up for your care. I just think,
I don't know if I'm so concerned about that, as I am concerned at the fact that with every private sector subsidy, it becomes an excuse to inflate prices, and then somehow all this money going into the private sector And we know in the UK, it's well known that these social care homes are not providing a service up to scratch with the money that is actually being paid into it. So for a lot of people, that's the reality. So it's just going to create more incentives for exploitation, more incentives for taking the money, but offering back a service which is actually quite poor. And because people are no longer paying for it, they don't even feel compelled to demand better services.
Yeah. Even having the central government pay for and arrange this care, there's no guarantee that that will be good care. But as long as, the fix for that is not to kick it over to the private sector. We've seen how non-responsive the private sector is to these kind of problems that come up in social care. I think the way to keep government honest in this respect is not through private sector involvement. But that's just an opinion.
Yeah.
That's not MMT. The MMT part of this is we need to ram home the idea that claiming to have run out of money as a way to say what the government are going to cut in terms of social provisioning, in terms of progressive agenda items is completely false.
Yeah. So my rant wasn't MMT. It was mostly a political rant. It's just that I guess the MMT part is the bit where they are actually lying about how the economy works and how money works in order to justify a political position that I am not in agreement with. So I guess that's the way you should see it.
And they're kind of doing it in the States as well at the moment. I see that the two Democratic, I'm not going to call them moderates because I don't think that it's a moderate position, but Kristen Sinema and Joe Manchin think that Biden's spending plan, which was already a compromise, is too costly. And they talk about how many trillion it is, and the news networks are not doing a great job of saying, actually, it's several billion over 10 years. But the point is that when they start talking about figures and going, look, it just sounds like a lot of money, so let's make it less money because I prefer the sound of less money. They're being ideological, and you can tell that they're not really interested in talking about what real things the government will deliver or won't deliver once they put these things on the chopping block. And so it possibly is the work of people who want to see these progressive reforms happen and Green New Deal, for instance, or, Biden's infrastructure plan. It's the work of people who want to get behind that to force these so-called moderates, these deficit terrorists, to say, actually, what will you cut from the, but don't say a number, say like which program will you cut? No, so they connect these people to the program, that they're standing in the way of, I think. And I think Senator Sanders did call them out and give them that kind of question to answer, what will you cut? And I believe Joe Manchin has shot back with, no, here's how much money you've got. You tell me what you're going to cut to make it fit my number.
No, that's convenient.
So he's completely flipped it around.
It's a way of apoliticizing the discussion, isn't it?
Yeah, or pretending it's apolitical, but it's just, maybe a way to change the question, get the question reframed, is to say to somebody, how much money has the government got? Ask them how much, ballpark, because you think the government can run out of money. How much money has it got? I guess that would, make the person think, oh, okay, well, yeah, let me add that up. And then once you start trying to add it up, it might become clear that the answer is actually it's infinity.
Yeah. I mean, I don't mind, and this is for disclosure, I am happy to have a discussion with any listener or anybody who, believe that social care should be in private hands or believe that, things like healthcare shouldn't be universal and has, very well-formed political views on this. I am happy to have that debate. I'm happy for the public to have that debate. What I'm not happy with is people pretending that it's about something else and trying to pass policy, kind of hide policy away from people, hide decisions or hide the motivations behind the decision by pretending that there are restrictions that we actually don't have and that there are constraints that we actually don't face. And I feel that the way that the IFS was talking about Rishi Sunak, about him being short of money, is a way of restricting the public debate because it is fundamentally a lie.
Mm-hmm. Okay, so let's get into some of these questions.
After all that.
I think we've set the scene. It's also, again, if you're new here, one of my kind of beliefs is that, we should be over about what our bias is, because I don't think bias is a problem. I think undisclosed bias is a problem. So now you kind of know who we are in terms of like our attitude towards politics. You can have a different slant if you want, but these core truths about the way the government spends, they don't change, but obviously you bring your views to it. We're just saying what ours are. So I'll read a question out here. This is from, it's a screen name, GJOESQ, or let's just say Josk. So anyway, Josk writes, I have a good basic understanding of how MMT relates to sovereign currency issuing governments within their own borders. However, I still have a very poor understanding of how MMT affects and relates to international trade. Warren Mosler categorizes exports as a real loss and imports as a real gain. That is, exporting businesses get foreign currency for the export of real goods and services. Importers, on the other hand, get real goods and services in exchange for their own nation's currency. Given that a sovereign nation's currency can only purchase stuff for sale in that country's currency, how can it be that it is seen as a good thing that businesses make money from the sale of their exported goods and services? Governments talk about export earnings and foreign trade as a boost to their national economy. Through the MMT lens, is this true? If so, how does this actually happen? If not, why are politicians always crowing the benefits of exports? Can exports be beneficial for an economy? If not, how can we disabuse our politicians away from their errant ways? So there's a lot to go at there, Patricia. I probably should have done that in sections, but
yeah. So what does Warren Mosler means when he says exports are a real loss and imports are a real gain?
Oh, you're asking me? I thought.
Yeah.
Right. I thought if I got to read out the question, you would have to do the answering.
I get to ask you questions as well.
Right. Okay. So what we want to do here is concentrate on the word real.
Yeah.
So that there is nominal wealth, which are pounds and financial assets, dollars, yen. That's nominal wealth. Real wealth is real things, labor and materials and products. And, so your real wealth, as Warren Mosler says, your nation's real wealth is your pile of stuff. Everything that you can produce domestically, plus everything the rest of the world wants to send to you. So your imports are also going to that pile of real stuff. And what makes that pile of stuff smaller is when you have to export. So your nation's real wealth is everything you can produce domestically, hopefully at full employment. This is a good argument for full employment. Why would you not have your economy at full employment? Because you could choose to be, if you're the currency issuer, you could make sure that, and MMT advocates for this, that everybody who wants a job, who's currently can't find a job, gets a guaranteed job paid at a socially inclusive wage, centrally funded, locally administered. So your pile of stuff is everything you can produce domestically, plus what the rest of the world sends to you, minus what you have to send to the rest of the world. So that if you look at it at the macro level, the way a nation or a person in charge of a nation should be thinking is, in blunt terms, that there is more to this, and we'll get into that, but the exports that you send away from the country represent a loss to your economy, because your workers, your domestic workers, have used their time and your materials to create products, and then instead of the nation that produced the stuff getting to consume the stuff and benefiting from consuming the stuff, they send it to another place in the world. They export it to another country for those consumers to get the benefit of it. So that's what we mean when we say the imports are a real benefit to the economy and the exports are a real cost in real terms. Again, so I just emphasize, concentrate on the word real. So I don't know. Did I leave any gaps in there?
No, I think that covers it. And Josk, he's right about, I'm assuming it's he, I don't know. He's right that there is an overemphasis on achieving exports, and MMT sort of puts that on its head, So we're saying exporting is actually a real cost to the economy. We are foregoing consumption in order for other countries to consume, for us to produce for other countries to consume. And but there is the belief that, the money is the more important thing. And I guess during the gold standard, there was more of a need to accumulate these foreign reserves, right?
Well, I think the way this imports and exports appear at the micro level, at the level of a business, if you're a business person or you're part of a firm and you're making stuff, you just want to sell that stuff. So if you sell it to somebody overseas and they buy it for, say, dollars, and you're in the UK and you can buy pounds with that because that's what you need as a currency user, as we talked about at the beginning of the show, then you kind of don't really care about imports and exports, and you see it as we're getting money from overseas. We're in the era of global competition. We're doing our bit. We're getting money from overseas. And so obviously an exporting business can be seen as a success story. And particularly if you are that business, you kind of don't really care who you sell it to, whether you're selling it, if you're a business in the UK and you make textiles and you sell them into Europe, or you sell them into the States, or you sell it domestically. You just need to make your bottom line, don't you? And you want to grow your business. So if it grows by going overseas, then it looks good for you. But that is looking at it through the lens of a currency user. And what we hate is, or what politicians can make a lot of hay out of, is when we buy imports, politicians can characterize that as, well, we lost out, in terms of that business in that other country is doing a better job of making this particular product, and that's we've lost jobs. They've taken our jobs, that framing, or we weren't competitive enough to retain those jobs. So those jobs have flown out of the country. As the government could, like we say, can afford to, because it has an infinite checkbook, can buy any resources priced in pounds, including those people that became unemployed because jobs, quote unquote, left the country. So, like we say, far from cutting government spending and hiking taxes, the government need to be going the other way when demand is too low. And one of the symptoms of demand being too low is unemployment's going up. People are looking for work that pays in pounds and they can't find it. And so the decision to, take more money out of the economy via higher taxes and lower spending is completely the wrong way to do it. So what we're saying is, when jobs, quote unquote, leave the country, that doesn't necessarily have to be a problem. That's us now buying things. That's that other country using their real resources to create products that we can buy. So now we've got freed up real resources in this country, and the economy can restructure, and it can do that a lot faster if we have a job guarantee, keeping labor employed and keeping demand at a level that gives everybody a job.
Yep.
When Joe talks about, governments talk about export earnings and foreign trade as a boost to the national economy, they're basically talking about it as if the government's a household and it needs to attract money from elsewhere. So through the MMT lens, that's not true. But, they talk like that because we understand the economy like that generally.
Yeah. There's another level to the imports and exports, which I guess is not related to the money itself. But the other thing is that it can, to some people, and in some circumstances, it can mean that your economy is, it depends what you're importing, basically. And you may not want to import things that are essential goods, that are essential to the economy, because it might put your economy at risk, because you have no control over what happens beyond your borders. And if those goods are not available anymore, you might run into trouble. You might, there may be some security issues to consider. So an exporting nation is seen, or there is this perception that it is necessarily a more secure nation. And that doesn't always work out that way.
Yeah, so a lot of the global south.
Yeah, a lot of the global south export a lot, but it's about what they export and what they import. So they export a lot of goods with low added value, like agricultural goods and things like that, but they import a lot of technology and actually things that are pretty essential to the functioning of their economy as a whole. That's a precarious situation to be in, regardless of what the figure says about exporting and importing. And it can also, as we said, exports are a cost. So sometimes these countries are continuously running exports and usually exporting into the wealthy nations. And I don't think that can be seen as a sign of security. I think that's more of a sign of subservience, even, or dominance of the developed world over the developing countries. But then again, as I said, these are political issues and other things to consider. So it depends, I guess.
Yeah.
Sorry.
But yeah, can exports be beneficial for an economy? Well, it seems to be okay for certain nations to be exporting. It puts them in a stronger position, but other nations that are exporting certain other things, low value added goods, who are importing high value added goods, they're basically having their wealth extracted from them.
Yeah.
Their real wealth extracted from them. So like Patricia says, it's about what those exports and imports actually are physically. But yes, MMT is basically trying to get the view out there that the numbers on the screen are less important than what's actually happening in the real world.
I should have said wealth extraction, actually. I think, not subservience isn't quite right.
Yeah. Well, yeah, I think it's not a bad word. So shall we move on to the next one?
Yes. So Nora Pareja, I'm assuming she's a she and maybe Spanish, I don't know, or Latin American. So she asks, I apologize for the long preamble, but here it goes. Someone who describes himself as a finance and tech guy and who has a significant following on Canadian Twitter. Who might it be? Recently tweeted that the Bank of Canada's ongoing purchase of around 40% of the government debt issued during the pandemic has increased inequality in Canada. I usually agree with this guy on political issues, so his opposition to the Bank of Canada helping to finance our COVID response, a response that was forced on our centre-right Trudeau government by the left-of-centre NDP party that holds the balance of power in Canada and which we both support, seemed wrong-headed to me. So I asked him to explain by what mechanism this actually occurs, pointing out that the last time this happened in Canada to the same extent was in the post-World War II era, when the Bank of Canada's debt purchases helped fuel Canada's growth and led to wildly shared prosperity in the 1950s and 1980s. In response to this, he said, the bank's purchases, suppresses rates below the normal function, the normal function, interesting choice of words, inflating the asset values of those that have it and deflating the wages of those that don't. He further said that it was not possible to compare the role of central banks pre-1970s because central banks have changed since then.
Can I just jump in there for a sec? Okay, I've recently seen this on Twitter as well, and I guess it probably came up in 2010 as well when banks were doing quantitative easing after the great financial crisis. We've talked about it a fair bit on this podcast, this idea that, correct me if I'm wrong, Patricia, but what Nora is talking about here is that Canada's central bank is purchasing government debt. That's quantitative easing. That's what we're calling it over in the UK and what they call it in the US. Am I right?
Yeah, QE.
Yeah, QE. And
what he's saying is that interest rates have dropped, which is what they're saying over here as well. That
kind of don't know where to go in with this, but
there's so much to address.
The idea is, okay, the way the monetarists, the neoclassical school of thought thinks interest rates work is you lower interest rates, it gets cheaper to acquire money by going into debt. Yeah. So the price of money's come down. So because it's cheaper to borrow, people go out and borrow, and that stimulates the economy. a rational person would go, it's not really the interest rate that makes me borrow. I borrow if I think I can borrow and make a profit because I've seen a business opportunity or something like that.
Yeah.
And if the interest rates are actually high at that point and I can still make a profit, I'm still going to go out and borrow. But anyway, that's just looking at it on the micro level. This has basically been the only game in town in macroeconomics for a long time now. The idea that we manage the economy by raising or lowering the interest rate, and the central bank controls the interest rate at which banks lend to each other, that high-powered money that we talked about at the top of the show. Central banks can control that, and that forms the basis of the interest rate that you and I as commercial bank customers can expect to see when we want to go into debt to maybe fund a new business venture or buy a car or something, or a house, So the idea is that making it cheaper to go into debt is a way to stimulate the economy. And it just hasn't worked, right? It's not working anymore. The interest rates can't get any lower. Economies around the world that have been practicing this kind of stuff have been undershooting their inflation targets. Another thing that, if you're new here, you might not be cognizant of is that central banks are generally, they are in this country and they are in the US, charged with creating and making sure that inflation stays at 2%, low and slow, they call it, low and slow inflation. Lower than that could indicate that the economy is going into recession and shrinking. And higher than that could indicate that the prices of everything is going up. And that makes everybody poorer. So they think 2% is correct. So just bear in mind that since 2008, since they started doing quantitative easing, this thing that many pundits said would cause hyperinflation, that was just printing money, and it wasn't, for reasons that we may not have time to go into in this one. But what it did is it brought interest rates down really low. So what we've got is interest rates going down really low, inflation going under what central banks are charged with creating. They've been undershooting it in their inflation targets since 2008 in most countries that have money systems like this. So what the MMT people are saying is, all right, look, I'll just leave it there for a sec. Did you want to jump in?
Well, I just think I'm going to pick up on the choice of words of this gentleman when he said that the government, by doing QE, the bank is pushing interest rates below their normal level. And what is the normal level? So we said before earlier that when the central bank issues bonds, it does it with not with the intent of funding any government spending. It does it with the intent of achieving a certain policy rate target. So the policy rate, the interest rate, is always driven by a target. There's always a target from the Bank of England. And so there's no normal level. The interest rate is what the central bank, well, the Bank of Canada in this case, decides that it is. And if the central bank didn't issue these bonds, decided it's not going to set a policy rate target anymore, and therefore it decides not to issue bonds, the policy rate drops to zero, which is why MMTs often say, and Warren particularly says, that the natural rate of interest is zero.
And that is the title of a paper that he wrote with
yes.
Matt Forstater. The natural rate of interest is zero.
Yes. So there's nothing normal about bond creation. Bond creation in itself is a policy decision. There's nothing natural about it.
When you're the monopoly issuer of a thing, if you want there to be an interest rate on it, you have to intervene to create an interest rate. You
need to make reserves sort of scarce so that banks lend to each other. That's the idea, right?
Yeah. Or you could actually pay interest on the, agree to pay, put it in an account and pay interest on it as the issuer,
Yeah.
So what's happened now is, and this comes up a lot, is, okay, low interest rates hurt low income people. And I just can't. I asked somebody on Twitter, again, somebody with a pretty decent following, sorry, what do you mean by that? And they said, okay, well, and they linked me to another thread that they'd created that everyone was like, oh yeah, what a great thread. This is really clear. And the idea is that if interest rates go higher, house prices will come down, because I'm trying to work through the sort of pretzel logic of it, that but basically, because more money will be going into servicing the debt because interest rates are higher, the purchasers of houses will have less money to spend across the whole economy. So vendors of houses, sellers of houses, will have to put their prices down. Are you following this?
Yeah, but how is that beneficial
Yeah, I'm sure this is what he was saying. I think we've got different worldviews on this, but again, the person on the street, the low income person, isn't like getting a cheaper house. They're still having to pay the same amount of money, but more of it's going into debt servicing. But their idea is, but the asset price has come down now. It's pushed the asset price down. I'm like, which is good for poor people. And it's like, right, okay, let's just be blunt about it. You've got rich people and poor people, and it gets more expensive to go into debt. Who does that benefit? How does anything getting more expensive benefit?
No, people with savings. People with savings are having a great time. What basically is, there is this correlation between interest rates and asset prices, right? And the data appears to show, and I think Randy Ray also spoke to us about that the data appears to show that there is a correlation that with low interest rates and high asset prices. And when we say asset prices, let's be clear, people mean houses, right?
Well, you and I might mean houses, but I think the people out there in econ Twitter and finance Twitter mean financial assets as well.
Well, but the houses are the thing that that ordinary people have to buy. I don't think people are too concerned about stocks, are they?
Absolutely, but again, I think the sort of finance bros on Twitter are like, if we're not getting a free lunch, because basically when you invest money in treasury securities in the US or the treasury securities in Canada, there's zero risk. So basically, if you buy $1,000 of government bonds, you're going to get it back with interest. There's no default risk because the Canadian government creates dollars.
Yeah.
So the idea is, and this is what Bill Mitchell calls it and Warren Mosler calls it, it's basic income for people who already have money, right?
So, but let me finish the thought that I was having, which is that...
I am sorry.
No, that's fine. I'm just going to forget if I don't say it. So basically, even if asset prices do go up, the reason why they might go down, if we increase interest rates, asset prices go down because there isn't as much demand for them as there was before. You know why? Because people are now putting all their money in bonds that give them an even better rate of return and an even safer rate. How is that a way to deal with excessive wealth? It's just giving the rich another means of increasing their wealth that is safer. It doesn't reduce inequality, does it?
Absolutely. I don't think that. I just went through the way they think it works. If I've understood it correctly, that like asset prices will come down if interest rates go up. But really, to low income people, I'll just out myself. I am one of those people. I rent. I don't own a home. Or it is so far out of reach to even own a home that you're like, okay, when you don't have any hope of owning any assets anyway, this idea that like, oh, it's going to be better for you if asset prices come down. And it's like, okay, so you've got a person with hardly any money and a person with loads of money, and asset prices come down. Who is that better for? Again, it means the person with more money can buy a lot more stuff. It doesn't, this whole thing never gets to, okay, you're the government. You can buy whatever you want that's priced in your currency that you issue. Is there a better way to solve a housing shortage than tinkering with interest rates? Can you possibly think of a way to, because if there's a housing shortage, there's not enough houses. And there's lots of unemployment, and oh my God, if only there was a way we could solve this problem. And it's like, yes, we'll have to let the central bank sort this out. And it's like, it's not a job for the central bank. There's not enough houses. Build some houses, or take some houses into public ownership and control rents. And, they voted to do that in Berlin recently. There's just a much better way of solving this problem. These people just seem very silly to me, these asset price inflation people.
I really dislike it when sometimes economists simplify the housing crisis as one single effect, especially with something as so removed from the housing issue itself as interest rates. Is a very indirect way of dealing with something that actually has very direct solutions and some not so direct solutions. So, the housing shortage is one thing, but what about the inequality between regions? The fact that all the jobs are concentrated in a single place. What about the fact that the rich, that we've had many, many years of financial liberalization now, where you can do basically, there's tons of ways of making money in a way that is not productive, and that has led very rich people to have so much kind of wealth that they don't even know what to do with it, and they just put it in all these assets in the first place. What about taxation policy? What about maximum wealth policy? What about restricting the purchase of houses to people who actually want to live with them? What about there's so many things.
And again, it's like anything but fiscal. It seems to be.
Yes, it's a very soft approach, and the issue is that it has much unintended consequences, and it's not actually dealing with issues. Just it's moving it aside a little. It's not really dealing with the issue at heart, which is that rich people are accumulating too much wealth. How about we deal with that directly?
So let's just talk about the MMT view of this now. So the idea is that the natural rate of interest is zero. So like Patricia said a few beats ago, the government has to intervene to create a scarcity of bank reserves to get banks to lend to each other, and that creates their positive interest rate. The way the central bank, at the government's behest, creates that shortage is to go into the secondary market and buy up government bonds. Basically, what they're doing is they're exchanging interest-bearing dollars. Let's stick with the Canadian frame, interest-bearing dollars, and swapping them back to non-interest-bearing dollars. And now the commercial banks in Canada, if it's anything like it is here in the UK and in the US, the banks are awash with reserves. They don't need to lend to each other. So that's brought interest rates right down since 2008. And the way Warren talks about it, he says we should just keep this permanent, like a permanent zero interest rate, because that's the natural rate of interest. And Warren's view, and I don't think it's just Warren's view, but that's who we've been talking to a lot lately, is if you raise interest rates because the government is a net payer of interest, it pays more interest than it gets in interest income. So because the government is a net payer of interest rather than a net recipient of interest income, there's this thing called the interest income channel, which and so the government's a net payer of interest from itself to the economy. And so if interest rates go up, this interest income going from the government to the economy increases. So that's the other way around to the way neoclassicals think about it. And therefore, it's likely to impart an inflationary bias. And again, the neoclassicals think when you raise interest rates, it's more expensive for people to go into debt. So it's going to cool off the economy. It's going to cool off demand. But because of this interest income channel, the MMT view is actually it's going to impart an inflationary bias. So, we're very much in the camp of, zero interest rate policy.
Do you remember, Christian, when we spoke to Richard Murphy and he spoke about the wealth from Pride and Prejudice, how wealthy people actually made their money?
Yeah.
Do you remember? And it was back then, the interest rate was 4%. So all rich people did was just buy government bonds, and then they would get an annuity of 4% of their wealth, and they didn't have to work. So, you can have high interest rates and still have a pretty unequal society.
So it was a long-winded answer. and actually, you actually put a button on your question, Nora, which was, do central banks purchasing government debt lead to increased inequality in the manner the Twitter guy suggested? My view is, and I think I speak for the MMT economists that we've spoken to, we kind of regularly touch on this subject. My view is, no, it doesn't. It doesn't, because what we're saying is central banks purchasing government debt lowers interest rates. And I think I speak for both of us, Patricia, we don't think low interest rates feeds into inequality. It's the other way around. I think I speak for you as well, Patricia.
Yeah. I think it's more leading to inequality to give people free income,
exactly,
which is non-productive, and then make it more expensive for people to actually invest in potentially productive outcomes.
Yeah, because so there's this idea that if Patricia just talked about the 4% owning bonds that pay an annuity of 4%. What's being said here with this low interest rates lead to inequality is people with capital that would like to buy that kind of a free lunch from the government will then go and invest elsewhere in places that might inflate prices and create asset bubbles, like they have done in the housing market. In a way, that's probably where there's alignment between us and this increased inequality view. Whereas, yes, that capital could then inflate asset bubbles, but the way to deal with it is not to be blackmailed into giving them a free lunch via government bonds. You know, the way to deal with that asset bubble is through that whole laundry list of things we brought up a few minutes ago. There's so much more you could do if house prices are unaffordable for most of the economy. There's so much more you can do.
Inequality was rising way before interest rates became so low.
Yeah.
What you've said, I think, encapsulated pretty well. The answer to inequality is not to give the rich a free lunch. You're just going to make things worse. The answer is to directly address the issues that we discussed, directly, take the wealth away from them if needs be, through taxation policy and fiscal policy, and making sure that everybody has a dignified income at the low income level.
Okay. Shall we do one more? After that outpouring of emotion and rage.
Yeah, it's been a very emotional episode. I apologize to everybody else.
Our next question is from Jeffrey Lucas, and he's numbered the questions. Okay. 1, I understand that Milton Friedman's idea that you control inflation by controlling the money supply has been debunked by experience of the last few decades. The conclusion being that governments cannot control the money supply. But doesn't MMT say you can control demand-led inflation with taxation? Doesn't this reduce the money supply? And why does MMT say this will work if we now know that governments cannot control the money supply? So let's start with number 1 then, Patricia. I understand that Milton Friedman's idea that you control inflation by controlling the money supply has been debunked by the experience of the last few decades. Could you just talk about that for a sec?
So I think the first thing to understand is that there are various measures of money supply. Money is a problematic term sometimes because people mean different things with it. We talked earlier about base money and reserves. So the government is the only entity that can create reserves. And taxation, yes, gets rid of the reserves. So if your definition of money is simply reserves, which to some people it is, then I guess you can say you are controlling the money supply. But we also know that there is a lot of money out there, or credit, that is being created by banks, by commercial banks, when you take out loans. And we've covered that in other episodes, so I won't go into detail. But it's money in the sense that it can be used to make purchases, and it adds to aggregate demand and has, effects that are very similar to other types of money. So, but it's different from reserves because this money has to be paid back into the economy. So when Milton Friedman was talking about that it was a monetary phenomena and that inflation just when he meant the money supply, I believe he meant reserves, so that you had to control the amount of reserves in order to control, that was effectively controlling the money supply, and that controlled inflation. He was wrong because, as we know, as we've just said, there's other types of money that does create demand and therefore has the potential to create inflation. So I guess part of that may have come from the gold standard and the time when you had, the reserves were linked to a certain amount of gold. So you had to take care that the reserves matched the amount of gold at the price that you had set for gold. And I guess that's a way of, setting the price of something and helping anchor the price level in a way. Do you have something to add to that, Christian?
Yeah. Okay. So let's talk about money supply. So the way I look at it is when the government wants to spend money, it creates reserves using the keyboard at the central bank and uses those reserves, pays it into the commercial bank's reserve account. And then that results in an increase in the recipient of the government's payment experience as an increase in their bank balance. Now, that money is M1, that measure of the money supply.
Mm-hmm. Yeah.
And so an increase in reserves via government spending has a corresponding increase in M1. So
we call M1 the narrow measure of the money supply.
Yeah. So the government spends the money that we use, M1, into existence that way, right? We can also, as private sector individuals, borrow money into existence. By that, we go to a government agent called a bank and we ask for some M1. We swap our promises. The M1 is their liability and our asset, the bank's liability and our asset. And, my promise to pay £1,000 back to the bank in the future, you can think of as money that I created. That's my liability. That becomes the bank's asset. They're going to get £1,000 off me in the future. And they give me £1,000 worth of M1, £1,000 worth of bank credit. And so that's the other way that M1 enters the economy and ends up on balance sheets. So M1 can be increased by the government spending it into existence or by the government lending it into existence and creating a corresponding level of private sector debt as well. So those two things net out to zero, but M1 does go up. The point is that the government cannot control M1 by quantity because there's this private sector element. It's determined endogenously from within the system. Yeah, that's what people mean by when the central banks realized they had to throw out ideas of controlling the money supply by quantity because it's endogenously determined. It's determined by how much people want to go into debt, how much the private sector wants to go into debt, as well as government spending. So, as Stephanie Kelton says in The Deficit Myth, cash registers do not discriminate. Cash registers don't care whether that bank credit came into existence via government spending or private sector lending. It's all one and the same to the economy. So that stuff goes round and round in this system. So the money gets spent into existence. It moves from bank account to bank account as we transact with each other. And then when the only way it stops existing is when, one, you pay the debt back as a private sector individual, or two, it gets taxed out of existence by the government, taking it and destroying it. So the way I think of it is the government does control the money supply, but by price, not quantity. To put it in blunt terms, it can and does control the price of money, how much it costs to go into debt. That's exactly what monetary policy is. So it has a rate that it wants to achieve in the commercial banks, and it controls the bank rate, which is the rate that banks lend to each other, to hit that target, and that's all guided by this idea that if you make it cheaper to go into debt, it will stimulate the economy. And if you make it more expensive to go into debt, it will cool off the economy. So I don't think I've left any gaps there, Patricia. That's what that's what the idea of controlling the money supply is all about. But like we say, nowadays central banks control by price, not quantity. And as we get to this era where we realize that the natural rate of interest is zero, I think your neoclassicals and your central bankers are like, well, where does that leave us? We're not doing anything.
Yeah, it was believed as well that banks lent reserves, as you say, that that we can control the amount of money lent out. There was the bank multiplier, I think that's called, as well, by fractional reserve banking.
Yeah, but again,
so that's been debunked now, I think. Some people still believe it, but they're becoming far in between, yeah.
Yeah, it can look like, because basically, banks only need to hold enough in their reserve account to clear payments between each other. So they only need to hold a very small amount of reserves compared to the liabilities that they've issued, the bank money that they've issued. And so people look at that ratio and think that like that's fractional reserve banking, but it's more of an after the fact thing, really, I would say. So doesn't MMT say you can control demand-led inflation with taxation? I think what MMT says is if there's too much spending power in the economy and you're getting inflation from that, yes, one way you can reduce the spending power of the economy is with taxation, but that's not the only tool in the tool shed, and it shouldn't be. And yes, it would reduce this measure called the money supply if you raise taxes. So Jeffrey asks, why does MMT say this will work if we now know that governments cannot control the money supply? Well, it can't target the money. It can't say, here's how many pounds will exist because of the endogenous money creation. It just can't dictate how many pounds will exist in bank accounts. It can't target a precise number, but it can control the money supply by raising taxes. It can take spending power out of the economy. So I hope that answers that question. Does that make sense?
Yes, it does.
Sorry, just to kind of put a button on that. I think people misread MMT economists as saying what we should do is spend or cut taxes or both until we get inflation, and then we deal with inflation then by raising taxes. And then that opens the door for critics to go, oh, well, politicians will never raise taxes at the right time when they need to. So MMT, yeah, they might be right about how central banks work, but they're naive about politics. That's why we reject MMT. And it's like that whole framework of spend, and then worry about inflation and raise taxes to combat inflation is not what MMT is saying. The only policy prescription in MMT is the job guarantee. And that is basically you spend just enough money to make sure that everybody who wants a job gets a job paid at a socially inclusive wage.
So the inflation control is kind of done before the spending takes place. And it's done basically by the assessment of whether the resources are available in the economy. And how might this happen in reality? Well, if the government wants to, say, spend into healthcare and it needs to hire a lot of nurses, they can see whether nurses are available at the current rate of wages for nurses. And if it finds that nurses are not available and that actually what you need to do is outbid the private sector in order to attract the nurses that you need, then that outbidding you're actually pushing the wages of nurses up. And, you might decide whether that's good or bad. But let's talk about, say, for example, resources in terms of the cost of wood or the cost of metal. So you are revising the wages or the price of a particular resource up when you are trying to outbid the private sector. And so you might end up having some inflation as a result of that. So if you don't want to do that, then you can say, okay, well, the resources aren't out there available at the moment. I'm going to have to raise taxes in order to be able to hire nurses or buy resources at this rate. Mm-hmm. That's how sort of the decision, the inflation control comes into the spending decision before the spending actually takes place.
So I am going to suggest that we leave it there for now. So yeah, I hope we've given you some food for thought, and always get in touch. We might not always be able to get right back to you because, Patricia's very busy these days.
Well, like you're not.
She's the clever one. So, we do try and eventually get around to making sure that it comes up on the show or in the Patreon editions of the show. So we hope we've given you some food for thought, and thanks for listening, guys.
I hope that was helpful. Yeah, thanks.
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month, and get access to patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino. And you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.